Well, you got to be flipping my flapjacks. New data has just been released here that shows hedge funds are selling stocks at the fastest pace they have in many years. Wow, that is fascinating. I can't wait to react to that. There's a bunch of things I got to react to in this video here today. That's just one of them. I want to react to this. AAI investor sentiment numbers just came out. This is to show if investors are bullish or bearish on the stock market over the next 6 months. And we have just witnessed numbers being hit that we have not seen since the great financial crisis. Yes, you heard me right. The great financial crisis. Whenever you're in that sentence or a sentence with the Great Depression, you know you're in a time. The AAI investor sentiment numbers now have come in 55% bearish or more. 3 straight weeks. Last time that transpired was March 2009. You got to be flipping my flapjacks. Can't wait to tell you guys my opinions and perspectives on that. Stock market crashes. How long do those usually last? What are we looking at here? Do I feel like we're still just going to be in a correction, or are we going to go to a crash? All those sorts of things. I'll share my perspectives there. Okay. Treasury Secretary Bezos on basically this notion of kind of not caring about the stock market. And I want to kind of tell you my opinions and perspectives there and how that's going to transpire. What is Trump's end goal? All we hear every single day right now is Trump's doing this. Oh, 200% tariffs on champagne and wine and all this stuff, right? Every day it seems like Trump, Trump, Trump. What is he actually going after? I think he's going after something much bigger than just these tariffs, okay? And I want to explain that whole game that's going on there from there, okay? Then I want to react to this video. This is a buying opportunity among all the negativity, says Piper Sandler's Craig Johnson. Looking forward to reacting to that one. And then I want to react to this video. Very concerned with how consumer is feeling right now. I got some very important information I want to share with you guys around the consumer, when to care, when not to care, those sorts of things. And from there, then we're going to talk about a bunch of stocks, which we have, some massive moves out there and a lot of stocks. Oh my gosh, okay, action-packed time. Appreciate you guys joining me as always. I hope you guys appreciate me taking the time out of my day to do this video for you guys. I know especially in these sorts of time periods, people really love to, watch my videos and see my content. So appreciate you guys for being here. One thing only I need from you guys, and it's for you to hit the like button on this video. Smash that like button. If you could do that for me, it takes 1 second. I appreciate you, okay? I appreciate you, and I appreciate you. Alrighty, so let's get started right off the bat. By the way, if you want to subscribe here, you can certainly subscribe. We're now over, what are we at? 80,000 plus subscribers. Appreciate y'all for being here. I want to start right here. Hedge funds having trouble beating the S&P 500, okay? And they're selling out of stocks massively. So it was interesting. Somebody left a comment on that post. I said, breaking, hedge funds have trouble beating the S&P 500. Somebody said, well, hedge funds, it's not their job to beat the S&P 500. And my thought to that is, first off, yeah, anybody that's in the market knows that. But if you really want to be on the hedge fund side, let's think about this a little deeper. Hedge funds are supposed to protect you and protect your assets, right? So answer me this. Why are hedge funds dumping out of stocks at the fastest rate we've seen in years when the Nasdaq's already down 13%, when the Russell 2000 is already down 19%, and now they're dumping out of stocks left and right? Let me ask you this. Why were these hedge funds not loading up on put options a month ago, 2 months ago? Why did they wait till right now to start loading up on puts? If you look at the put option volume this week, it's been astronomically high. Why weren't they loading up on puts a month ago, 2 months ago? Aren't they supposed to mitigate risk? Oh, so they're not doing either of their jobs. They're not outperforming the market, and they're not prepping up or hedging for their clients at all. Because if they were, they wouldn't have to worry about selling stocks heavy right now. They wouldn't have to worry about put options right now and loading up on put options right now. But as I always tell you guys in regards to hedge funds, one thing matters only. It's that they sound intelligent to their high net worth individuals. So when they go on the golf course with Mr. Johnson and he has $175 million net worth, and he's got $50 million invested in the hedge fund, and he's with the big dog down there, and they're playing golf, and he says, hey, man, market, I heard it was going down a lot. You guys did you guys sell? Yeah, we sold. That's all that matters. And they're like, oh, good job, right? Oh, man, I heard that NVIDIA stock was going crazy. You guys own NVIDIA stock? Oh, yeah, we own NVIDIA stock. That's all that matters. That's all that matters in the end. A lot of these high net worth individuals don't really look at it in terms of, well, how much was the market up versus not? Did they really protect my assets? A lot of times these hedge funds will underperform the market when the market's going up and underperform the market when the market's going down. They'll do worse. It's insane. So don't ever try to stick up for the hedge funds, okay? That's what I'll tell you in regards to that. These guys are clueless. They're sheep. They're not clueless in the respect of they understand how to make a lot of money because they understand how to get high net worth individuals to give them their money, essentially. But they're clueless in regards to actually understanding the markets and how to actually perform well. Like, hedge funds are no different than any other industry. You got some doctors that are the best of the best and they're incredible. You got some doctors that are meh, some doctors that are bad. You have some teachers that are unbelievable teachers. You have a lot of teachers that are just meh, it's just a job for them. And you got some teachers that are good, right? And some teachers that are bad. Every industry is like that across the board, okay? Next up here. So this came out. AIA investor sentiment numbers came out 3 straight weeks now. 55% plus of investors are bearish on the stock market the next 6 months. And then the last time we've seen that is March 2009, which is when the great financial crisis stock market crash ended. We had a double bottom, essentially. We had a bottom in the fall of 2008 into the winter of 2008, and then we had that bottom in March 2009. So what's my opinion on this? Does this show me something very important? Yes, it shows me that we're very close to a bottom likely on the stock market. Now, I hope we're not. Why? I'm 35 years old. I have more income than expenses. If anybody is not retirement age right now, and you have more income than expenses, which I hope is everybody watching this video right now, and if you don't have more income than expenses, get on that ASAP. I'll preach it till I'm not doing this game anymore. I'll always preach it. More income than expenses. If you have more income than expenses and you're not retirement age, you should want the market to keep going down. Why would you not? It just means you're going to make way more money long term. It's a simple game. If I had an option to buy the S&P 500 at 6,000 or 3,000, I would much rather pay 3,000 than 6,000. It's a simple game, okay? But listen. These individuals are all on the bear side right now, and they've been here for a few weeks now, and they're loading up on puts. Market's going to likely switch the other way. My guess is market bottoms here in March and we start moving up. I hope that doesn't happen. But if I had a guess, if you told me I had a bet $50,000 on the market bottoms in March, or it doesn't bottom in March and we go lower, over April, May, June, I would put the $50,000 if you forced me to. I wouldn't bet, but if you forced me to bet on one way or another, I'd bet the market's going to bottom in March. Seeing how bad the sentiment is, all this stuff, and everybody getting so tied up into this, right? Tariffs and everything. Dude, as soon as people start getting so used to tariff drama, they're not going to care anymore. It's just going to start rolling off. And once you kind of get all that fear out of there, then you start moving up again. Now, additionally, you know what else this shows me, and this is kind of the scary thing? It shows me how weak mentally the investor community is now. That they were able to go this far bearish, the most bearish they've been since 2009, off of tariffs, off of Doge. We have an unemployment rate right now that's in the 4s. We have inflation that's dead. We have a Fed that's in a lowering cycle. And people got bearish this easily? Wow. It was that easy to make them the most bearish we've been since unemployment was on its way to 10%, since a banking system was collapsing. and we're back there with this? That makes me think, what would happen if we had unemployment rate go to 10%? What would we have happen if the banking system was collapsing? If people got this bearish off of this Trump drama, oh my gosh, you're going to be flipping my flapjacks. Come on, man. Now, stock market crashes. Stock market crashes usually last a little over 300 days, right? And the market goes down about 32%, which right now S&P 500 is down like 10%. So that would be a long way down from here. By the way, if you ever want to follow me on X, I always have that linked in the description area down there, okay, just so everybody knows. I also have my Instagram always linked in the description area of all my videos, so if you want to follow me on X. Some of my posts get quite a bit of views. This one got 45,000 views. This one got actually 385,000 views, so, X has been popping. But corrections, usually SP 500 goes down about 14% on average, so would mean only a few more percent from here, and then usually you recover in about 4 months. Do I feel like we're headed toward a crash? Or is we just still in a correction? My opinion is we're still just in a correction. I don't see a super high probability we're going toward a crash. I would gladly welcome it. Gladly welcome a crash. Once again, as a 35-year-old who's got more income than expenses, like everybody should have, crash. Go down, baby. 50%, 30%, whatever. Doesn't matter. Like, it means nothing to me. Nothing. But on the flip side, I don't think we're going there. I don't think we're going to crash. And the reason being, at the end of the day, is what do we have to go off of to crash? Like tariffs? Doge? It's very questionable how much Doge is even cutting, by the way, and how much they're even going to be able to accomplish. And the tariff drama and those sorts of things, like, what? If you tell me, okay, we're going to have some massive recession, unemployment rate's going to go 10, 12%, okay, yeah, I can see us going down 30, 50% on the market, and we're having an actual crash. But to get there from here, it's not going to be easy. And so my kind of thought about that is like, correction. This looks like a very normal correction overall, right? It's a nasty correction than Russell. Russell was down 19% here today, which means the Russell's very close to a crash. Crashes are usually 20% plus down for an index, and the Russell's getting very close there, so it's in a severe correction. The Nasdaq being down about 13, 14% is in a good-sized correction. S&P 500 barely just reached correction at a 10% down number. So, the different indexes are at different places in regards to that. No, the White House talking about, they're not concerned about the market, they're concerned about the economy, these sorts of things. As I've been saying to you guys recently, like, it doesn't surprise me at all. Why would they care about the stock market right now? We're not in election time. Midterms aren't about to come up, right? We're not going to have a presidential election. Like, there's no incentive to have the stock market go up short term, right? But there's a lot of incentive to have the stock market go down short term, and we'll get into that just in a moment in regards to Trump. But as of right now, any weakness in the stock market can be put on Biden, right? Even though Trump's in office, Trump and the team, they can just say, oh, this is Biden's stock market, this is Biden's mess we're cleaning up. And you can hear in the rhetoric, his team talks about, Trump and his team. We're cleaning up a mess here, it's a disaster, those sorts of things. So they're just very, very easy to kind of push the blame onto Biden, and it's Biden's fault, and that's why the market's actually going down. We're having this detox period and these sorts of things. This isn't our fault, this is Biden's fault. And so at the end of the day, like, it's just a very easy time period for them to have the market go down. They, like I said, like, by the time midterms come, it's like, that's over a year and a half from now. No one's even going to remember this drop in the market. No one's going to remember this by then. With how fast a news cycle moves and how fast everything goes, dude, no one's going to remember what was going on in the stock market in March of 2025 by the time it's election time and you got to vote for who you want in office. No one's going to remember this, other than the people that were super into the stock market like me and you, right? It's all going to move on. No, that gets into Trump, right? Trump says, I'm not going to bend at all. Trump doubles down on tariff plans as stocks sink. He's not concerned about the market. He's Mr. Tariff right now. What's Trump's grand plan here, okay? Here's the deal, okay? Here's the deal in regards to Trump and what he's actually trying to do. This is way bigger than tariffs, okay? Tariffs, blah, blah, blah. What Trump's actually trying to do, he's trying to force the Federal Reserve to start cutting rates substantially. How do you get the Federal Reserve to start cutting rates? Market volatility. It's always been that way. Economic weakness certainly helps. Inflation being dead certainly helps. Market volatility, it always comes back to that. If you look back at every single time period, the market went through tremendous volatility, right? Other than when you're in an insane inflationary cycle or something like that, the Fed always ends up cutting right after. I've seen it continuously. Look back to the tech bubble. Tech bubble, massive market volatility. What's the Fed start doing shortly after? Cutting rates. Great financial crisis. Massive market volatility starts to pick up. Fed starts cutting rates. 2018, Massive market volatility then in 2018. What do they start doing in 2019? Cutting rates. Rona, massive market volatility. What does the Fed do? Cut rates to zero. And this will play out the same way. Bunch of market volatility, and what's going to end up happening? Rates are going to start being cut, right? And so that's Trump's grand plan here, because Trump wants to think about, how do I set up the economy to be as good as possible 2026, 2027, 2028, right? The years that he'll really be judged, right? And so he wants to reset interest rates much lower. So then corporations can take out debt for much cheaper. Individuals can take out debt for much cheaper. Somebody can get a mortgage for much cheaper. If somebody can get a mortgage for much cheaper, it's more money they can spend in the economy, helps real wages, all those sorts of things, right? Could potentially bring down rents, which could also help real wages, right? And then those folks that own those properties could refinance at lower rates. So that's what Trump's trying to do, in my opinion. He's trying to get the Fed to basically cut. And the more market volatility they can cause in the short term, the more the Fed's going to look out there and say, okay, inflation's dead. We're getting a lot more tells of recessionary type numbers. You look at the Atlanta GDP numbers, real-time GDP numbers, those sorts of things, right? You get market volatility. The Fed's going to look out there and say, let's get cutting, because they don't want to get too far behind in regards to this, because they get too far behind. They already got too far behind in the hike cycle when inflation was going crazy, right? So now they can't get too far behind on the other way. So my opinion is the Fed's going to look at all this and say, why are we going to keep interest rates up here? Why? When we have all these data points that are showing us, let's get cutting here. And so I think we'll start seeing 50 basis point cuts across the board, likely many of them this year, and even leading into probably the beginning of 2026, and before they're finally done cutting rates. And that's what I think Trump ultimately wants in the end, right? So that's what's going on here, and I think that's a grand master plan. I got to give Trump's kudos in regards to he actually is pulling it off. The market's getting really volatile. Inflation looks pretty dang dead to me. And you got commodities market that's dead right now. We could look at GSG in a minute if we want to. It's playing out. So he's got it in regards to that, okay? Alrighty, let's react to a couple videos. Then we'll do some stock talk about some opportunities I'm looking at in the market, some stocks that I think are, some pretty extraordinary opportunities, and some new stocks that might be buying here shortly.
He is chief economist at Annex Wealth Management. And for the technical takes, we've got Craig Johnson, chief market technician at Piper Sandler. Craig, I'm going to start with you. You made some great calls. It is a very, very scary time. I get it. They're talking about this on the general.
A very, very scary time. If you're new to the market, maybe. Dude, this is not I just think about the stuff I've been through in my 16 plus years in the stock market. And I'm like, this is not a scary time. Are you freaking kidding me? Like, for somebody that started in the great financial crisis, you want to talk about a scary time when we're on the cusp of losing the entire banking system, the entire financial system, which is the bedrock of the American economy? When home prices are crashing, something people thought would never, ever happen in the history of the United States, and home prices were diving off a cliff. Where I lived at that time in Phoenix, Arizona, I mean, real estate prices were going down 30, 40, 50%. Come on, man. When I think back to the Rona crash, talking about we're going to close the economy for 3 years, that was the talk. That was scary times. In 2022, inflation that was going to levels we hadn't seen since the 1980s, 1970s, that was scary times. Tariff talk? Scary times? Russia and Ukraine might do a ceasefire here? What? This is scary times? Not to me.
News media, which maybe is good, maybe it's not. I don't know. You look at the charts, you strip the emotion out. What are the charts telling you and your team right now?
Brian, thanks
I don't want to hear I don't want to hear chart master. I thought he was going to talk fundamentals.
Thanks, Kelly.
Sorry.
Appreciate you having me on.
Always looking for sort of these little economic indicators and data points. What is this telling you?
You know, it's telling us that the consumer is concerned, and we've seen that in a number of different consumer sentiment surveys, whether it be the University of Michigan or the Conference Board surveys. And then we turn and look at our own internal numbers. In the month leading up to the inauguration, we saw sales growth of 13% year over year. And you just pointed out, week ending February 22nd, we're down 26%. So it's almost as if a light switch has been flipped and the consumer confidence is drained out of the economy. And in spite of the discussion I heard in the prior segment, this is actually a consumer-driven economy. And so that's our biggest concern, is that if consumers are pulling back from purchases such as footwear, which they need, they're going to be pulling back in a lot of different areas. So we are very concerned about how the consumer is feeling right now.
I have like 8 different questions, so I'm just going to kind of rattle them off. Do we know, A, if tariffs have already affected the price of footwear? B, if footwear is so discretionary, consumers are just pulling back there because they can? C, if unseasonably cold weather, because this was the week of Feb 22, was one reason sales were down so much? And D, now that we're into mid-March, are you seeing any rebound?
Yeah, all great questions. So let me try to answer them as best I can. First and foremost, that was a big week, down 26%. But even if you stretch that out 7 weeks since the inauguration, we're still down 13% cumulatively. And so we are seeing foot traffic down and sales down. I mean, from a broader perspective, as we think about discretionary income and how tariffs impact costs, we've been paying tariffs since 1930. We have upwards of $4 billion a year in tariffs, even before the first and second 10% came on.
Dang, Foot Locker 15? Shoot. I might have to buy some freaking Foot Locker. I was just at Foot Locker this weekend, actually, getting a few things. And the store was packed, man. I had to wait in line and everything.
Just a few months ago with China. And so we know that costs will go up. Are they going up exactly at this moment based on the tariffs that were applied a few weeks ago? The answer to that is no, but if you look at the president's own data, it shows that as import costs go up and the cost of goods increases at the border, the consumer price index for footwear increases with it. And so that's why we're sounding the alarm and joining what is a chorus of executives across all different sectors of our economy talking about the uncertainty that these tariff proposals drive within our consumer base.
You know, one of our favorite analysts, Laura Champagne, who we have on all the time, mentioned almost in passing the other day that some of the names she covers in the sort of casual footwear space, like Crocs, in particular, were under pressure. But she said that was more of a shift to dressier shoes. That's a much more hopeful story than I think the one that you're telling.
Yeah, I think the other thing is uncertainty. The consumer definitely needs certainty. So even if you don't go ahead with massive tariffs, let's say on April 2nd with the reciprocal proposal that's being bandied about by the administration, if they don't proceed on those, you're still driving this uncertainty into the consumer mindset. And so they're spooked. So they're going to hold back and pull back from their spending plans. Now, if you fast forward to that April 2nd date.
Hey, real quick, let me finish this guy off, and then I want to talk about Crocs stock, because I do get asked about that stock decent often, and I want to talk about
they
that.
End up applying tariffs across the board, even for those countries, or those companies, I should say, that have diversified out of places like China and have moved to other locations over the last 15 years,
right,
are going to find themselves sideways with the U.S. government and having to pay an additional tax. These are American companies paying additional taxes at the border just to provide the basic necessity of footwear to our consumers. And so with 99% import penetration right now, there's really nowhere to go to try to alleviate some of that cost pressure, which inevitably will hit the consumer.
So before we get into stock talk and some stocks that I'm watching and thinking about starting positions in and all that good stuff, let me just speak about Croc stock real quick here. Because I actually do get asked about that one. Like, it trades really cheap. You know, why not buy something like that? Here's why I don't buy Crocs. One reason only. This is the only reason I don't buy that stock. I'm not sure if it's a fad. There's a decent probability, it's certainly no guarantee, but I think there's a decent probability it's a fad. And so, you know, a fad is basically a business where it has incredible sales, it's a very hot product, you know, for a few years, and it seems like everybody wants to wear it or use it or something like that. And then the fad breaks, and then that company's just kind of in no man's land for a long time, and maybe they end up going bankrupt, right? And I could give you a billion examples of that, of companies, right? Some that come to mind would be GoPro. Remember, the action camera was, if we go back 10 years ago, it seemed like everybody was going to get a GoPro, right? It was a fad. Fitbit, same exact thing. Like Fitbit, we go back 10 years ago, oh my gosh, like everybody's going to get a Fitbit. It was a fad, right? And so you can go across industry after industry, and I could give you a billion examples of like fads, and they come and they go, right? And they're like super popular, and it seems like everybody wants this thing, and then it just kind of fades off. I like companies that are going to be there decade after decade after decade. Nike, not a fad. Like Nike, every decade. 1980s, the 1990s, the 2000s, the 2010s, the 2020s, still stays highly relevant, has a massive product assortment, and has a brand that represents something more than just a one-off hot product for the short term or something like that, right? And so that's the sort of companies I want to position into, ones that are going to be highly relevant and extremely profitable and great companies 10 years from now, 20 years from now, 30 years from now, right? Companies that might outlive your portfolio. Like that's where you really want to be. You don't want to be into these things that are just here today, gone tomorrow or something like that, right? Because it doesn't really have a moat around its business, right? It's like, yeah, Crocs are the hot thing right now. The kids want to wear them, but I don't know, 2-3 years from now, is that same still like that? Maybe it is, but it might not be. 2-3 years from now, the kids might not be like, oh, Crocs are so cool anymore. It might, slowly stuff starts to get like seen as like, oh, that's corny, right? Oh, that's lame. You're wearing that. Like that was so 2 years ago. That was cool. And then they're on to the new thing. So yeah, don't count on that. Okay. Now, in regards to other stocks I'm looking at, opportunities out there, RH has been hammered. By the way, real quick here, I thought this was relevant. It was something I was looking at earlier. I was looking at how well Celsius stock is holding up. Celsius stock is holding up extremely well. Like you look at all this market weakness here recently, and Celsius is actually positive. It's holding that $25 plus level very well. What this shows me is when the market does recover, Celsius is set up to be a slingshot. Meaning this stock is set up to go absolute beast mode once the market starts to actually recover. Whether that's tomorrow or next week or next month, whenever the market starts to move upward again, Celsius is going to go beast. I can see it. I mean, at the end of the day, when you see a company continuously, shareholders holding that stock strong and buying during a market downturn, that's a good sign, man. That's a really good sign, especially if you're in a correction or a crash. And so I think Celsius set up very, very well here. RH, keeping an eye on that one. If it goes under 150, I might get interested in that one. They do have bankruptcy risk. That's the risk in regards to RH. Because the CEO made a horrible move that I've talked about many times, Gary Friedman. He blew the money on a buyback. It's so silly at a very bad time, in my opinion. It should have just held cash. And so, I'm keeping an eye there. I don't know if I'll ever buy it, but I am keeping an eye on it. Toll Brothers, is another good example of a stock that, I don't like the home builders right now. I'm probably not going to like them for a while here. But, Toll Brothers, man, I would be interested in buying Toll Brothers sooner if they had just stacked cash. But they're another perfect example of a company that forgot that they go through ups and downs. And I look at the decisions the board of directors made, the big dogs at the company, and spending so much money on dividends and buybacks recently. And I'm like, you guys should have just been stacking cash. The housing industry goes up and it goes down. It's very cyclical, right? And sometimes these home builders are making more money than they could have ever dreamt. And other times it's like they're trying to rub a few. Ask the home builders how much money they were making 2002 through 2006. All the money in the world. And ask them how they were doing 2007 through 2011. Devastating, okay? And so the last, 5 years have been great for home builders. They made more money than they could have ever dreamt, more money in history, right? And they could have been in a situation, somebody like a Toll Brothers could be sitting on billions of dollars of cash right now. Billions, right? Just ridiculous sums of money and earning crazy interest income. But instead, these companies decided, to... And the thing is, like, if they just held so much cash, when they go through these downturns that maybe last a year or a few years, then you can buy your competitors for pennies on the dollar. You can buy land for super cheap, right? You could buy more materials. Like, there's so many things you could do. You could do big share buybacks with a very low share price. Like, oh my gosh, you could do so much. But they rather have the stock go up short term, so they do those buybacks when their stocks are already at all-time highs. I'm just like, what are you guys doing, man? But the home builders do that time and time again. So anyways, that's housing stocks. So it's a lot of Red Dead Redemption out there. As far as big tech goes, a lot of Red Dead Redemption as well. Even NVIDIA ended up finishing red here today. Now, Adobe, looking at this guy, Adobe's been devastated here. Adobe on a 1-year basis is down 34%. Adobe, such a great company, but I'm a little scared of it, and I've been speaking about this really for the past year or two. The thing that scares me about Adobe is I feel like they're actually legitimately being slowly disrupted by these new AI apps that can do things as far as photo and video and whatnot. So Adobe kind of scares me a little bit, even though it's such a great company. It's one of those that you would think, like, just an easy buy. But you start looking at so many of these new, products that are out there, and it seems like they're going to slowly start to eat into Adobe. And that's a little scary, right? Shopify looks like a good buy here. Salesforce, same exact thing. Salesforce actually down about almost 11% in the past year now at this point in time. Meta's steal deal. Amazon steal deal. Apple continues to get hammered here, down to 209 Apple is. But, Apple's still up 22% in the past year. That's something you got to keep in mind here in regards to Apple. It's like that stock could easily get hit a lot harder than it's been hit, right? Like, if Apple goes down on a year basis, then we're talking about some real damage in regards to Apple. But if you look from the peak, Apple's now in a severe correction, essentially. Apple's down 19% from the high, so it's in a severe correction. But it's still not in a crash. Could the stock get in a crash? For sure, if the market continues to be weak. If the market continues to be weak, Apple's going to for sure end up in a crash. If the market starts to bounce back, here in the next week or next couple of weeks, then Apple will probably bottom out around, let's call it 205 or so. Now, outside of that, PayPal looks really, really attractive here at 66. It's the first time PayPal's been really attractive in probably about a year, right? And his downfall here recently has been pretty dramatic. And PayPal's not a small cap stock, certainly, right? But it kind of gets its performance is very similar to the Russell 2000. When the Russell 2000's up and up and up, PayPal moves up and up and up. And when the Russell 2000's sinking, the PayPal has a lot of troubles, and that's exactly what we've seen. The Russell's been insanely weak here recently and has really affected PayPal very negatively, right? So that's just kind of what's going on there. As far as possible buys watch list here, I'm still doing work on TTD. I know that stock continues to get leveled down to $53. That stock has been obliterated. In the past 6 months, it's down 49%. Year to date, it's down 54%. Oh my gosh. On a 1 year basis, it's down 32%. On a 3-month basis, it's down 59% in the past 3 months. So I'm still doing research on TTD, Trade Desk. I'll have an update for you guys at some point in regards to if I think that stock's a buy or not. But I got more work to do. I don't like to rush it in regards to that, right? Especially right now because there's a lot of other opportunities out there in the market. So I'm still doing work on TTD. We'll see. Elf on a Shelf looks like a snack at 62. Give me it, baby. Shopify. Cake? You would be kidding me. Cake at 44? Let's go, baby. Let's go. I mean, Cake's got the next 10, 20 years. Everybody can worry about the next 10, 20 days. I'm worried about the next 10, 20 years. And Cake's got the next 10, 20 years on lock. And so I love Cake. I love Cake. Literally and figuratively. Ulta looks actually decent here at 314. Fubo looks really good as a speculative stock. SoFi at $11 looks pretty good, right? Obviously it comes with risk. It's in the banking space. We know that, right? And if you're talking about recession fears and all that, SoFi is always a risk. And so do keep that in mind. That's why it's an $11 stock. But the risk reward is pretty insane there because it's like as long as they make it through this mess and make it through another recession or two in the future, I think Anthony Noto can grow this company into a financial giant, and we're talking $100 billion, $200 billion market cap on this company long term if we're talking 10, 20 years from now, and that's a pretty attractive ROI on that one, right? Looking at something like a Red Rock, if we're talking about interest rates going down substantially here over the next year, then that bodes very well for companies like Red Rock that have to take out debt, right? Also companies like Wynn Resorts that have to take out debt to build new properties and then refinance debt and those sorts of things. So I'm keeping an eye on some of these sorts of stocks as well because they could end up emerging as a pretty big opportunity. So Red Rock's lost about a quarter of its value in the past year. Year to date is down 4.5%. On a 6-month, it's down 22%. And on a 3-month, down about 14%. On a 1 month, down about 18.6%. So that one's in a severe correction. So keeping an eye on stocks like that as well. That and Win. But yeah, so anyways, and then AMD continues to be a snack here. Alrighty, guys, appreciate you joining me as always. Thanks so much for being here. If you're looking to follow me on X or Instagram, that's always linked in the description. Additionally, I'll put my private stock group. If you're looking to apply, join private stock group, private wealth group, get access to 1000xstocks.com. Access to all my course curriculums, teaching you everything I got up here. Scale your wealth up, all that good stuff. Pin comment down there. Click on that, fill out a form, see if we can get you access to that either this weekend or next week inside the group. Okay. Much love and have a great day.